In this video, we're going to talk about LBO, or leveraged buyout. A leveraged buyout is the acquisition of a company using a significant amount of borrowed funds to pay the purchase price of the company. So, leveraged buyout is an acquisition transaction. The acquirer is a financial sponsor because it's orchestrated by a private equity firm, also called a financial sponsor, as I mentioned, or group of private equity firms, also called a private equity group or a consortium, which will take ownership of the business after the acquisition has been completed. Usually, it is a 3 to 5 year investment horizon, followed by a sale after. Generally speaking, the debt will constitute a majority of the purchase price after the purchase of the company. The debt-equity ratio is typically around 2 or 3x. Usually, the total debt will be about 60 to 80% of the purchase price. Ability to generate cash flows and repay debt is the key. Operational improvements are an integral part of increasing cash flows. In an LBO, the cash flow generated by the acquired company is used to service and pay down the outstanding debt. For this reason, while companies of all sizes and industries can be targets of LBO transactions, companies that generate a high amount of cash flow are the most attractive. As a summary of LBO, the return expected on the investment or internal rate of return is between 20 to 30, sometimes up to 40%. The exit time horizon, as we mentioned, is 3 to 5 years, and the capital structure is a mixture of debt and equity, and debt is the majority of the deal capital structure. Bank debt is usually paid in 6 to 8 years, and higher yield debt is paid in 10-12 years. As per exit multiples, the common practices are to consider EBITDA, PE ratio, and enterprise value by EBITDA ratio. And potential exits or sales of the company would be IPO or initial public offering, recapitalization, or sale of the company to make profit on the initial investment by the private equity company.